All right, again, welcome everyone. The Community Action Partnership has a grant from the Office of Community Services to develop and manage the National Risk Mitigation and Quality Improvement TNTA Center, more simply known as the National Training Center. In addition to developing an online resource center in conjunction with NASCAP, we also create and promote tools and webinars on topics of interest to the CSPG network. All previous recordings and copies of presentations are available on the TNTA website through the Resource Bank. To access the TNTA Resource Center, you can go through the Partnerships website and click on National Training Center, NASCAP's website and click on CSPG Clearinghouse, or go directly to www.csbgtta.org. If you have not already registered and have a username, there is a short registration process, well worth it to explore the Resource Bank, Consultant Bank, discussion forum calendar, or to submit a request for training or technical assistance. So to start off today's webinar, we're going to do a little bit of technical information. You should be able to hear me out of your computer speakers. If you have any audio issues, you can restart the audio feed by going to the Communicate menu at the top of your screen and join Audio Conference. If you would like to give verbal comments throughout the webinar, and there are a couple of opportunities where we will be opening the floor, you should use your phone. The phone number is also on that Communicate tab under Teleconference and is in your confirmation email. You will need to use the phone number, the access code, and the personal ID number that will show up on your computer screen on that Communicate tab to be able to participate verbally. If you have any issues at all during the webinar today, please find me in the chat window. Again, that's Cashin U. Or you can email me at cyiu@communityactionpartnership.com. I will put that in the chat window momentarily, and I do check that throughout the webinar. There will be a couple of poll questions that will appear on that right side panel, and we do appreciate your participation in those. If you lose track of any of your features, there are tabs across the top where you can pull them down again. You can submit questions using the Q&A box also on that right side panel at any point during the webinar today. We have an hour and a half to allow plenty of time for questions and feedback. And with that, I think we will turn it over to Anita and Michael at CapLaw to get us introduced and started for the day.
Thank you, Cashin. This is Anita Lischblau. I am the former Executive Director of CapLaw, and I have with me Michael Shepsis, who is a staff attorney with CapLaw. For those of you who may not be familiar with CapLaw, let me just tell you at least what it stands for and a little bit about what CapLaw does. Community Action Program Legal Services is the full name, and CapLaw provides training and technical assistance on legal and financial issues to community action agencies around the country through consultations, through webinars like this, through in-person trainings, and so forth. So what we're going to focus on this afternoon and this morning, for those of you on the West Coast, is part one. There's a two-part series. Part two is on Thursday. We'll talk more about that in a moment, but part one is today, and we're going to talk about some of the issues raised by OMB Circular A-110, which of course are the administrative grant requirements. And this stems from a project that we've been doing with Community Action Partnership that is a guide to A-110, which we will also talk about in a few minutes. So we're going to talk about the agenda. The first thing we're going to talk about a little bit on a fairly general scale is OMB Circular A-110. What is it? What are the general provisions of it? Where does it fall within the scope of other requirements and so forth? What does the circular say? And then we're going to talk today about how does the circular apply to the following areas: financial management standards, availability of funds, codes of conduct, and monitoring and reporting. And we're going to do that in a format that's a little different perhaps than the typical webinar. Rather than just kind of talk at you, we're going to use the format of the guide to discuss issues through the use of hypotheticals and polling questions. And these, you will see, are based on actual cases and decisions that have been issued on different provisions of OMB A-110. And I should also mention here, we'll mention again later, but these are the topics we'll be discussing today. We will be discussing other topics related to A-110 on Thursday, such as procurement, prior approval, subawards, and so forth, and we'll go into that more at the end of this session. So what is OMB Circular A-110? It is the uniform administrative grant management requirements for institutions of higher education, hospitals, and nonprofit organizations. Obviously, the one that we're most concerned with here are nonprofit organizations. Now, some of you on the line may perhaps be public community action agencies, and so that will be a different circular that will apply to you, but we're mostly going to talk about A-110, which is for nonprofit organizations. OMB issued Circular A-110 a number of years ago in the 1980s. It was codified, maybe about 6 or 7 years ago in 2 Code of Federal Regulations, Part 215. And what I mean by that is it was actually placed into the CFR, the Code of Federal Regulations, that houses all of the various federal regulations issued by different agencies in the federal government. Now, there is also OMB Circular A-112, and a common rule promulgated by each federal and local government grantee, by each federal agency, and that does apply to state and local government grantees. And it's a little bit different than A-110 just in terms of format. A-102 is more guidance from the federal agency, from OMB rather, to the federal agencies, and it's a fairly general document. It doesn't go into nearly as much specifics as A-110 does. And then the common rule is more in the format of A-110, and that is, as it suggests, a common set of rules that are actually promulgated by each federal agency to apply to state and local government grantees. There are also, of course, other OMB circulars that are relevant for administering federal grants and federal grant funds, and that would be the cost principles for nonprofits. That would be OMB Circular A-122. For colleges and universities, it's A-21, and for local governments, it's A-87. And then lastly is OMB Circular A-133, which relates to the audits of state and local governments and nonprofits. So we usually refer to A-110 as the Uniform Grant Administrative Requirements, but of course all of these different circulars kind of work together in determining how you will be administering your federal grants and federal grant funds. Okay, so how do the administrative grant requirements apply to you as a community action agency? As I said before, the federal agencies actually adopted and in some cases modified Circular A-110. The agencies had the option of promulgating it and adopting it as is, or there were in some cases certain selections or alternatives they could make in terms of modifying it, and some of them did that, such as HHS, for example. So HHS codified Circular A-110 at 45 CFR Part 74. HUD did so at 24 CFR Part 84, and the USDA did so at 7 CFR Part 3019. Of course, there are many other agencies, but these are 3 that many CAPs will have to deal with because they do get grant funds either directly or indirectly from those agencies. But it's particularly important that you become familiar not only with just A-110, which is kind of the generic template, but also with the specific rules that apply to the specific funding source, because as I said, there may be differences. Just one example, actually in 45 Part 74 for HHS, is that there's something specifically in there about permitting grant funds to be used for writing proposals, and that's not addressed in the cost principles in A-122, so that's just one example. So what informs the application of the OMB Grant Administrative Requirements? We want to sort of walk through here what you might look to for guidance or for authority on these particular rules. And this comes up because sometimes you may get, for example, a finding from an agency that's monitoring you. and they may say, well, you can't do X. Well, why is that? Because it says that in, you know, A-110 section 24, something like that. And perhaps they don't say that at all, then you've got to certainly ask what section is it that they're relying on. But sometimes they'll say that, and you're still not really clear from reading A-110, well, what does that really mean? So it's helpful to understand how are these decisions actually issued and who issues them and what sort of authority do they have. So if we look at this chart here, there's the grantee, that would be you. There's the funding source, and if it's a direct grant, like Head Start, for example, that might be ACF, the Administration for Children and Families within the U.S. Department of Health and Human Services. That might be within HHS, and then you might have the Departmental Appeals Board, which is part of HHS, but is an administrative agency that, for example, will hear decisions or challenges to cost disallowances, perhaps. Maybe your funding agency has done a cost disallowance, and you might also hear challenges to a termination of a grant, like a Head Start grant, for example. So that's the administrative body. And then the federal trial court, it might actually go to trial, either an appeal from Departmental Appeals Board, for example, or it might go directly to federal trial court in some situations. They may also interpret these rules. That's the federal trial court, and then it may be appealed even further to a federal appeals court, like, let's say, the D.C. Circuit. For example, this happened recently with a challenge to the Head Start regulations. And that initially went to federal trial court of the District of Columbia, and then that was appealed to the D.C. Circuit Court of Appeals. So what is the future of the grant administrative requirements? There are going to be some changes, I would say. In the next probably year or two, some of you may have heard or read about what we're calling the super circular. And this goes back about 2 years. OMB, Office of Management and Budget, said, you know, we're hearing that there may be some helpful, some useful reforms that could be made in these rules. And so one thing they were trying to do was, can we, instead of having all these different circulars that apply to different parts of the grant process and that apply differently to different types of entities, that's confusing. It's confusing for grantees that might have different types of grants. It's confusing for the funding agencies because there are sometimes slight differences among the rules that apply to different types of entities. Sometimes there are more significant differences, but it just makes it cumbersome to actually administer the grants and to fund the agency. So let's see if we can come up with a uniform set of standards for all entities that receive federal funds. The good news is that much of the administrative grant requirements, reforms that OMB are proposing, CAPLA believes are actually good for community action agencies and good for administering grants in general. So that's the good news. And if you want to sort of know more about the reforms in more detail, you can actually look on the CAPLA website and see the letter that CAPLA, or the comments that CAPLA sent to OMB on the proposal back a few months ago. The final version of the proposal will probably take effect in 2014 or 2015. And that will not take effect, of course, until but two things happen. Until, one, OMB decides what to do with the comments that it received. It will probably make further revisions to that proposal before it becomes a final piece of 2 CFR of the regulations. And then even when it is a final piece from OMB's perspective, it does not become actually enforceable until the specific federal agency actually adopts it as a regulation. And only then would you see it as something that would be enforced, generally speaking anyways, enforced on a particular grant. And as we go through this, you know, we're going to be commenting when there are specific proposed reforms that relate to one of the issues that we're talking about. So you'll hear as we go through this, we may say, oh, this proposed reform would do such and such. So you'll hear about that as we go through. Okay, so we want to talk a little bit about, Cashin mentioned when we first started, what we're calling the Spotlight on Nonprofit Grants Administration, an annotated guide. And this is just kind of a mock-up of the Spotlight, the publication that I believe is now available, or if it's not currently available, will very soon be available on both CapLaw's website and on the partnership's website. And I want to talk a little bit about it. Michael's going to then take over the reins and talk a little bit more about it because Michael was really the primary author of this publication. But what we were trying to do is something we did kind of a similar version of with Circular A-122 a number of years ago. Again, what we found was that although there are rules in A-110, some of the rules are not that clear and really only become understandable and once you have applied them to specific factual situations. So that's what we have done. Michael will talk about how we did that, but we've sort of gone through and found specific cases, decisions, and so forth that have interpreted or applied these rules, and we've sort of seen what can we learn from those rules. So I will turn it over to Michael, and he will go from here in terms of talking about that.
Thanks, Anita. So in putting together this guidebook, we examined administrative guidelines, such as the HHS Grant Policy Statement, administrative decisions, such as DAB decisions. We looked at federal court cases, and we even looked at audit opinions and findings. And we did all of this to bring to life the OMB Circular A-110 rules and to see how authoritative bodies have considered and applied these rules to real-life situations. We believe that this guidebook will be useful to all levels of staff at your organization, including program directors, compliance staff, executive directors, and board of directors. And we also think this guidebook will be useful for CSBG state offices, attorneys, and accountants. There are also many ways that you can use this guidebook. The table of contents lists the rules in chronological order of how they appear in 2 CFR Part 215. At the end of the guidebook, you can find practical guidance on key issues that relate to financial management and procurement. At the end of the guidebook, there is also a list of decisions that we used, and they also appear in order of how they also appear in how they relate to the rules in order of how those rules appear in 2 CFR Part 215. And the guidebook will be available on the internet. So now let's take a look at some of these sections and topics in A-110. This will be a quick look, as we will delve deeper into these topics later on in this webinar and in Part 2 on Thursday. But please bear in mind that this is not a comprehensive look at everything in the rules or even a full look at everything we cover in the guidebook. This webinar examines only highlights of limited portions of some of the rules found in A-110. The guidebook and these webinars are not a replacement for actually reading the rules and familiarizing yourselves with the rules found in A-110, as well as the actual version of A-110 that applies to your grants. So here we have a couple of highlights from the general provisions and pre-award requirements. As you can see, generally grant recipients must apply the OMB A-110 Grant Administrative Requirements to subrecipients that are institutions of higher education, hospitals, or nonprofits. In addition, subawards and contracts may not be made with individuals, companies, nonprofits, or other entities that are debarred or suspended. This rule also applies to principals, and principals are broadly defined to include officers, directors, partners, and principal investigators. This rule also applies to key employees, such as managers and supervisors, and other employees that have control and influence over the use of federal funds. And this rule also applies to consultants. You should also be aware that some agencies, like the Administration for Children and Families, known as ACF, require certification that subrecipients and contractors are not debarred or suspended. The government maintains an excluded party list at www.sam.gov. And the really important take-home message here is that it's very important that you have a system in compliance to make sure that you're not doing business with anyone who is prohibited. So here you can see some of the post-award requirements for financial and program management. There are standards for financial management systems, and we will explore these in more detail later on in this webinar. There are also rules concerning payment methods. If your organization maintains written procedures to minimize the time between the receipt of funds, if you have written procedures to minimize the time between the receipt of funds and their disbursement, and you maintain satisfactory systems of financial management, the default rule is that you may qualify for advance payments from the funding source. There are also rules for cost sharing or matching. These apply when an award requires that you contribute a portion of the cost of a program, such as with a Head Start grant. And there are also there are rules for program income. If you have a federally funded program that generates income, then either that income will be included in addition to your other federal funds, or it can be used to meet your cost sharing or matching requirement. And there are also rules for how and when to obtain prior approval to revise a budget or program.
Michael, I just want to mention one thing about the super circular here. It would make a change in terms of the payment method, or at least potentially make a change. Right now, as you said, the default rule is that, at least for direct federal grants, you get a cash advance. So in other words, for Head Start, you can get cash advances that you can use then to actually pay your payroll and so forth, rather than a cost reimbursement. However, that is, as I said, that is the default rule. That is what the federal government must do unless there are financial issues that make that not advisable. But the change in the language, which was very slight, and I must say somewhat disturbingly was not actually pointed out in any of the summaries that OMB issued, it would make it discretionary so that the agencies could make advances, but that would not be the default rule. It would be up to the agency, and we did comment on that. So we're hoping that that remains as it is rather than changes to the discretionary language.
Okay, great. So over here we can see some of the post-award requirements for property. If you use federal funds to purchase real property, you will own that property, but the funding source will retain an interest in it. That means that you cannot encumber the property without prior approval from the funding source.
An encumber would mean, for example, a mortgage or a lien, something like that would be encumbering the property.
Right, exactly. And also, if you used federal funds to purchase property, and then you are done using that property, or you need to dispose it, you must seek out instructions from the funding source. And the rules are also similar for equipment. If you use federal funds to purchase equipment, the government receives an interest in that equipment. And also, like with real property, you cannot encumber it without first gaining or obtaining prior approval. There are also additional rules, such as every 2 years, you must conduct an inventory of your equipment, and you must also track certain information, such as the type, the serial number, the location, and other information. And you can actually find out more about this in our guidebook or look at the rule directly.
There's also been a proposed change in this that I think could make it easier for grantees. Right now, you really have to sort of sit and wait for the funding source to tell you what to do with equipment once you no longer need it, how to dispose of it. The proposed language would have some sort of default rules that grantees could follow without necessarily getting specific instruction from the granting source, from the funding source. So that, I think, would make it easier to dispose of equipment once it's no longer needed.
So here we can see post-award requirements for procurement. You must maintain a written procurement policy that facilitates open and free competition to the maximum extent possible. you must conduct a cost or price analysis, and you should also document big procurement decisions. You must also have a code of conduct policy that defines what a conflict of interest is, and we will go into more detail on this later on in this webinar. And please be aware that cap law provides sample policies and other tools to help you write your own policy, which you can find on our website at www.caplaw.org under the Tools and Resources section. Lastly, we have post-award requirements for reports and records. It's important to remember that you must manage, monitor, and report on each project, program, sub-award, or activity. You must also submit performance reports, and you should be aware that the funding source may make site visits and request access to reports and personnel. You also have a responsibility to keep grant records and reports for up to 3 years from the submission of the final program report. However, it is good policy to hold on to these records for 4 years.
Now, one proposed change, which I think is a good one, will allow automatically records to be kept in electronic form. Right now, agencies treat it differently. HHS says you can do so if you notify them in writing, but it's always sort of been unclear. But this will clearly state that you can keep electronic records either initially or you can scan in paper records.
So now we're going to switch back to Anita as we take a closer look at some of the rules by looking at hypotheticals, situations, and some polling questions.
And the way we're going to do it here is you're going to see the hypothetical in front of you, and I'll just go over it, but then we're going to just be silent for a moment for you to think about that. And what we're going to ask you to do is to either put comments in the Q&A that's up there, or if you'd like, you can call in and make verbal comments. Cashin, can you remind folks how to do that if they're not already connected via phone?
Sure, yes. Like she said, if you are listening to your speakers, you can go to the chat window and I will read them out. If you'd like to do things verbally, there is a teleconference button near the top of your screen if you pull down that green little menu there, and it will give you 3 pieces of information to be able to call in. And once you do that, you can raise your hand to let us know that you'd like to be unmuted.
And we're going to, it's a bit of an experiment to see if we can kind of get the engagement that we do in an in-person seminar when we do these. But we really would like folks to participate and give us your thoughts, comments, questions based on these hypotheticals. So I will go through them now, and then we'll give you a minute to think about them and to pose your comments and questions. What issues or problems do you see with the following? Due to high turnover in accounting staff, cash reconciliations at a CAP were often prepared 2 to 3 weeks after receiving a bank statement. Internal financial reports were prepared only 4 times during the course of the CAP's annual grant period. The monthly budgets that were prepared reported actual costs incurred and actual income received. So it's just going to be silent for a moment while you either make some comments in the Q&A or if you want to just think about writing some things down and then call in. Okay, have another just maybe 30 seconds or so to get some questions in, some comments in, or audio questions via phone.
We appear to have a shy bunch today. I actually only have seen one that has come in through our chat windows, and no one with a raised hand.
Okay, can you read off the comment then?
Sure, it says the circulars require a budget to actual be done.
Yep, that is correct. The circulars do require that. So if you're talking about financial statements, whether they're internal or to the board as well, they certainly should include a comparison between actual and budget. That is correct. Any other comments? On the
That's all I see.
Okay, well then, Michael, what do you see in terms of the first bullet there?
Well, 2 to 3 weeks after receiving a bank statement is probably too long, and it shows a lack of potentially internal controls, a lack of maintaining accounting records, and these are required by Rule .21, Standards for Financial Management.
Yeah, the standards for financial management, some of them are not all that specific, but these were two things, too. There were actually many other points in a decision that Michael has read, that I believe it was a DAB decision, where these were just a few things that they pointed out as being problems, showing problems with their internal controls. So certainly in terms of reconciliations with bank statements and cash and so forth, 2 to 3 weeks would be too long. Perhaps maybe 2 to 3 days might be appropriate. We actually did a version of this session at the Chicago conference, the CAP conference a few weeks ago, and we had a fair number of financial people there, and one person said, you know, she does this reconciliation really on a daily basis. She checks online the bank statement on a daily basis, so she's constantly checking this. So, you know, the idea that this would only be done 2 to 3 weeks after receiving a bank statement would be problematic. I also just want to mention in another situation, it wasn't one of the ones that we looked at for the guide, but more recently I came across a newspaper article about I believe it was a nonprofit, it wasn't a community action agency, where it was either the CFO or someone in the finance department had embezzled over $1 million over the course of a couple of years. And at first was doing it in this incredibly simple manner, and you just wonder how no one found out about it. And that was that she was writing checks out to herself in her own name. She was able to do that with her software system and somehow erase the record of it, but it would have been easily found out if someone other than her had actually been looking at the bank statements and the checks coming in, the canceled checks. So, you know, this is sort of, I think, ground zero in terms of trying to prevent against fraud. All right, we will now do.
Well, actually, we did have a comment on this. Someone wrote, the risk for fraud is much greater because the cash is not being managed in a timely fashion, and that's exactly right. The length of time that it's taking them to reconcile their cash is a weakness in their internal controls and in their accounting.
Of course, another thing is that you need to make sure, this is sort of also standard practice, is that you don't have the same people reconciling the cash and the bank statements as are actually issuing the checks, as happened with this CFO situation I just described to you. Okay, I think we're now ready for the polling question.
Sure. We will be opening that up. That should be popping up on your screen at the moment. And you will have a minute and a half to answer on this. And in the meantime, we actually had a request if you could repeat the reference that Michael made a moment ago to the cash reconciliation decision.
A reference to the rule or to the decision itself?
The comment says decision, so.
Oh, well,
I can let me know.
Sure. Well, actually, we don't have the name of the decision in front of me, but I could probably look that up during the course of this presentation. The rule itself that related to was the rule in Section 215.21 of the CFR.
Some of these hypotheticals are a combination of a couple of different decisions rather than just one, but we'll try to get that for you before the end of the presentation.
Well, actually, I think that hypothetical was loosely based on the decision. It was a DAB case called Babyland Family Services, Inc., DAB number 2109, and that's from 2007.
And by the way, you can easily find these decisions just by Googling Departmental Appeals Board, and then it comes up decisions, and if you have either the name or the year or the number, you can easily find it that way. Babyland, I believe, was a Head Start decision, wasn't it?
I think Head Start may have been involved.
I think it was. Okay, so the polling question you have up in front of you, which of the following is required or is a provision of 2 CFR 215.21, and there could be more than one answer, so select all the correct answers. High turnover among accounting personnel must be reported to the funding source. Financial management systems must provide effective control over and accountability for all funds, property, and other assets. C, budgets must be certified as accurate by outside financial auditors. D, financial outlays must be compared with budget amounts for each federal grant award. So we'll give you a moment here to do that poll. Answer as you think appropriate.
Yes, and it actually just finished while we were going through that reference a moment ago. The poll was open. So would you like to see the percentages of results?
Yes, please. That would be great.
All right, so it should be popping up for you momentarily.
Okay, so not too many people chose A. The largest number of people chose B, financial management systems must provide effective control over and accountability for all funds. Not too many people said budgets must be certified as accurate. A number of people said financial outlays must be compared with budget amounts for each federal grant award, and a number of people didn't answer. Uh-oh, we're going to give you a tongue lashing for that one. I think that the poll answers are pretty accurate. The correct answer is B and D. So B is really the sort of this general language in terms of requiring accountability for funds and assets. And D is what we discussed a moment ago. Financial outlays must be compared, in other words, expenditures must be compared with budget amounts for each federal grant award. So I think most people got that. Okay, we're going to go on to hypothetical number 2, and we'll use the same methodology here. I'll just go over it quickly and then leave you a minute or two to kind of think about that, put some comments down, and then we'll go back and discuss it. So what issues or problems do you see with the following? A local CAP purchased a copy machine for $1,200 with federal grant money. To document this expenditure, the CAP made the purchase with a check that was authorized by the executive director's signature stamp, which is then photocopied and retained along with the canceled check that it later received. The CAP also noted the model name and series description next to the journal entry recording this expenditure. Okay, another minute or two. And again, if you have any comments, you can either do it via the chat or you can call in. I believe that Cashin can unmute your line and we can hear it live audio.
We can. I do not see any hands raised for people that have asked to be unmuted. We do have two different people that have kind of come in with a pretty similar comment. One that says that there's no documentation of the procurement process, and then someone else that was asking were there any invoices to document any purchases.
And I think that's exactly right. You really hit upon the issues there. Ideally, you would want to see some documentation of the procurement process. Now, that's not a lot of money there, $1,200. You know, it may depend on what your particular procurement policy says. commonly it might be over 1,000, it might be over 5,000. So it depends on what your policy says, but typically even at that fairly small amount, you want to see some sort of documentation that there was some sort of competition, even if it was just sort of going online and looking at different quotes or looking at a website to see what different coffee machines were, what the prices were for different coffee machines. It didn't necessarily have to be a formal bid process. And then there does seem to be a problem with the expenditure itself. As you said, where's the invoice? You would think that there should be some sort of invoice and something showing that, in fact, they had actually received the copy machine. So, those things are missing. Another thing that when we talked about sort of a similar issue in Chicago a few weeks ago, a lot of people started talking about the whole issue of the signature stamp and whether that was something that is a good practice or not. And to be honest, people had different opinions on that. Some people did say it was really a necessity, especially, and some of them were state associations that said, well, our executive director travels quite a bit, and so we really do need to have a stamp, but we have a very thorough written policy as to when that can be used. The stamp has to be locked up. The executive director has to, or whoever has the signatory authority, has to give some sort of written okay to use the signature stamp, actually has seen the backup for the expenditure and so forth. So, and then other people said, no, we would never use a signature stamp, just too risky. So that in itself was kind of controversial. We don't say that there's any particular rule one way or the other on the signature stamp in terms of specifics, but obviously just as in general, you have to make sure that there's accountability. So we certainly recommend that it be locked up very closely, only certain people have access to it, that there be kind of a log of when it was used, that whoever is giving the okay has actually seen the documentation for the expenditure, and so forth. So that there be a closely held policy, a closely followed policy for use of the signature stamp. And again, the model name and the series description, well, that's nice, but that's not really enough. There really should be an invoice. And some people also question, well, why would that be done in a journal entry as opposed to kind of a purchase order type process or something else? So those are some other issues that might have come up. Okay. We also just received a comment from Rick stating that the serial number should also be recorded. And certainly, I would hope that there is some kind of tracking system for all of the equipment that records serial numbers, locations of the equipment, and other requirements as required in the inventory, as required in the equipment rule. Although we should just point out that under the federal rules, I believe that it's only over $5,000 that is considered equipment. So you may not necessarily need to put all this information into your inventory since it was under $5,000. We have another comment here.
There are two more here.
There's no, I believe you hit on, there's no reference here to price or cost analysis. That's right. So I sort of included that as part of the no documentation of competition, but that is correct. It's a somewhat separate issue. There's no price or cost or analysis, and one or the other is required for all procurement purchases. And again, not sure whether the signature stamp is acceptable. Depends on their policies. Should have been approved, another comment, should have been approved of a check request or some type of internal paperwork to document the purchase. And that's absolutely correct. Again, this is something that's not specifically required by the rule, but really goes to the issue of accountability. We certainly recommend, as this person did, that you have, for example, either a cover sheet, a signature approval sheet, or maybe it's done electronically, so that you've got the people who need to okay it, a record of the fact that they have looked at this expenditure and that it has been okayed, rather than just having the person who signs the check be the one who takes all responsibility for it. There should be something that shows that the person who is head of the project or the program or the department that this copier was for has approved it. It should be someone who is okay with it, showing that it's in the budget. and then someone in finance. So there should be a number of different people that would approve expenditures, and that should all be in your policy and documented in some sort of signature process. Yes, it is really. It is not equipment. It is supplied. As I said before, I think that would really be more, since it is under $5,000, it would be considered supply rather than equipment. So it wouldn't have necessarily the same inventory requirements. Although, if you wanted to, if your policy says you're going to have an inventory for everything over 1,000, then of course you'd have to follow your policy. Okay. I think we will then go on to polling question number 2.
All right, that will be opening up on your screen momentarily.
And that should be say which one of the following is our provisions in 2 CFR 215.21. So that will be one answer only.
And then you've gotten started on the poll question, which is great. You do have about 45 more seconds to get an answer in. All right, it will be wrapping up here in about 10 seconds. So if you were in the middle of a thought, go ahead and click on in. And the poll is officially closed at this point, and we will be able to display those for everyone in just a moment.
Okay, so which one of the following is provision in 2 CFR 215.21? 0 people said use of signature stamps above $1,000 is prohibited. Of course, I think I gave you a clue to that earlier on when I basically said that. B, cost accounting records must be supported by source documentation. 47% of you said that. And C, 22% of you said equipment records must provide a description of the serial number, model number, federal stock number, national stock number, or other ID number. B is the correct answer there. Cost accounting records must be supported by source documentation. Okay, let's go on to the next.
And just a quick note, I mean, C is a real rule, but that's a rule that comes from Section 215.34, which addresses equipment, and not 215.21.
So that was kind of a trick question,
Kind of
Michael,
a trick question, yeah.
Michael wants to keep you on your toes. Okay. So we're going to go on then to talk about some of those standards for financial systems. I won't go through all of this. I think we've already kind of discussed some of these, but just so you know, that rule does require complete disclosure of accurate, current, and complete disclosure of financial results. So let's sort of take that apart for a minute. I think accurate knows, you know what that means. Current, though, I think is important because sometimes we've seen that financial statements will be, 2-3 months old. That's not terribly helpful. It should be current both for internal purposes as well as for the board. Current may not necessarily be every 2 or 3 days, but certainly, if we're talking about statements that are 2 months old, 3 months old, and if your software, if your program, if your system does not allow you to have current statements, that is going to be problematic. It's also going to be problematic in terms of doing your reports to external sources like funding sources. We talked about number 2. Everyone correctly identified that. I mean, that's critical. So whether it's an invoice for the application of the federal funds, it's also identifying the source. So I assume you all have this. It's maybe pretty basic, but you obviously need to have a system so that when you either bring money in or spend money, it's clear what money you're spending. What are you charging this to? Not only what account number, in other words, not only it's going to be salaries or equipment or whatever, but what is the funding source? So there really needs to be 2 ways to code every expenditure, at least 2 ways, and one of those is what funding source are you charging it to? So obviously that's pretty basic, but that's key, and sometimes we've seen where these grantees have not been able to do that. It's not been done that way. Effective control over and accountability for all property, funds, and assets. Again, that's very broad, but that's sort of a guiding principle that you should be using, for example, when you are drafting your financial policies, when you're executing them, when you're doing internal monitoring, is how can we have the most effective control over and accountability for funds, property, and assets. What else? We talked about this as well, comparison of budget amounts to actual expenditures. One thing I want to note on here is that Capital Law has done a series on this earlier this year. This is really something not only for people at the top, it's not only for the executive director and for the CFO, it should also be something that your program people see, because they're the ones who are going to be looking day to day to what amounts are being expended, and they need to know how are they doing, where are they in terms of budgeted amounts versus actual expenditures. And this, for just one example, this comes up when you're dealing with allocation of compensation. So if you've got a big staff and you've got people that are budgeted to more than 1 grant, as will often happen, and it's tricky. It's very difficult to keep track of, okay, how are we doing on expenditures? You may think that someone is supposedly working on Grant A 30% of the time, Grant B 60% of the time, and Grant C 10% of the time. But in reality, it doesn't always happen that way. And if you don't keep very close track of what the actual allocation of time is, and therefore the actual expenditure of compensation on that grant, you're going to be in trouble. So that's something that the program, the person who's head of the program really needs to have that information as well. Number 5, written procedures to minimize time between transfer of funds to grantee and their disbursement. Certainly this is obviously critical for advances. I mean, that's really what it relates to, is advances. And particularly important for Head Start. We know there have been a number of situations where Head Start grantees or other grantees that get advances, but it's often Head Start, where they have used Head Start funds to pay for other expenditures, for example, or have held on to it and earn interest and that sort of thing, and that is not allowable. It's supposed to be used very, very quickly within a matter of days for Head Start funds that are appropriate and allowable. Written procedures for determining the reasonableness and allowability of costs. We talked about this a moment ago in terms of sign-offs. For expenditures, especially if they're not in a budget specifically or even where they are, do you have procedures that ensure that somebody, for example, who understands the cost principles, who understands A-110, is looking to see whether a cost is allowable and reasonable under the grant. So that's got to be someone with somewhat of a financial background, although your program people should also understand the parameters of that. So what are the procedures for ensuring that every dollar that goes out the door that is paid for with grant funds is done in an allowable fashion? Accounting records and supporting source documentation, we talked about that as well. That's critical. The monitors, the auditors are going to come in and be looking for that documentation. Okay, so what does 2 CFR 215.21 really mean? Well, a couple of tips here that we can get from this is make sure that you're spending your federal funds appropriately and in line with approved program budgets. Now, that doesn't necessarily mean that you cannot ever deviate from your budget, especially with federal grant funds. You often can deviate maybe isn't quite the right word, but there is some flexibility in terms of program budgets, at least for federal grant funds. You know, one thing you need to really make sure of is that when you first get a grant in, make sure you and the program people understand what the rules are about flexibility in the budgets. It's really all over the map. Federal funds, federal grants, there tends to be more flexibility. You don't have to go to the funding source for every little change in the budget, but many times that's different with state money. Often your state grant people will want to know if there's any change at all from the program budget. Hopefully that's not the case, but you need to know from the get-go what are the rules about when you have to get prior approval from the funding source to make any changes in the budget. You also need to understand that Part 21 is suggesting and saying that the Board of Directors is ultimately responsible for adopting sound managerial policies, implementing the system of financial management, and so forth, and assuring compliance. Now, of course, the Board of Directors is not in your office on a day-to-day basis. There's no way, even if they wanted to, that they could know what's going on at an incredible level of detail, but they are ultimately responsible. So the questions that the monitors and the auditors are going to be asking them is, you know, what are the policies? Have you reviewed them? Are there policies on, let's say, the signature stamp? Are there policies on how you ensure that there aren't inappropriate conflicts of interest? How have you implemented a system of financial management? Is there separation of duties? These sort of basic questions that the Board of Directors will be responsible for. You know, is there an attorney that reviews your operations every once in a while, or your personnel policies to ensure compliance with, for example, employment laws? It also, of course, is talking about creative, effective internal controls over checks and cash disbursements. We talked about that a little bit. The separation of duties, understanding how, for example, the check disbursement process works. Are there purchase orders? Whatever it is, there are different ways of doing it, but has that been tested? Is there effective internal control? I think we talked about those others, and we'll go on to the next slide. Okay. A note on check writing and internal controls that we can learn from 2CFR. Certainly a best practice is to require 2 signatures over a certain amount. That certain amount will depend on how big your organization is. I'm aware of one very large community action agency that has budget close to $150 million. They require 2 signatures anything over $500. Others, it may be over $5,000. So there's no one rule about it, but certainly 2 signatures over some amount would be a best practice. And often many organizations say that 1 signature is internal, 1 signature is external. So 1 signature is a board person, like a treasurer, and another signature would be internal, like the executive director. Check signers should carefully review the checks and supporting documentation. So it's not terribly helpful if the check signer just has the check, doesn't know what it's for, doesn't have the backup documentation. We certainly would recommend that they actually see what the backup documentation is for the checks. As I said before, it does not directly address signature stamps, but we certainly recommend that if you do have them, that you limit access to them and have other policies in place that it be locked up, and make sure that whoever is using the signature stamp has clear authority from the signatory to use the signature stamp if it's not the signatory himself or herself that is using the signature stamp. Another best practice is the finance director should not be a check signer. That's the separation of duties idea. Yet another best practice is the treasurer should review the bank accounts for unusual amounts and transactions. So we certainly see that in many caps that the treasurer will actually be reviewing the bank statements, and not only the bank statements, because these days the canceled checks are sometimes not actually in the bank statements. If they're not, they should be actually looking at the checks themselves. Somebody outside we would recommend, this is not required, but we suggest that as a best practice, that certainly somebody should be actually looking at the checks, and perhaps it should be someone external like a treasurer. For unusual amounts and transactions. And the bank statement should be reconciled by someone without check signing authority.
Okay, now let's take a look at another hypothetical. So take a moment or two to look this over.
And of course, don't be shy. Do let us know through the chat or Q&A window what you think about this one. There's not that many of you on the phone, but if you are, of course, you can raise your hand.
Let's take another 20 seconds. So a CAA recently completed its grant year that ran from June 1st, 2012 to May 31st, 2013. The CAA charged payroll for the first 2 weeks of May 24th, 2013 to June 6th, 2013 to the 2012-2013 grant year. The CAA also signed a 24-month lease for building space for May 15th, 2012 to May 14th, 2014. The CAA charged the lease expense that it incurred for May 15th, 2012 to May 31st, 2013 to the 2012-2013 grant year. So are there any issues or problems?
Yes, we actually have probably 5 or 6 different comments that have come in, many along the same lines. The portion of the payroll for the period June 1st through the 6th would not be allowable as it is outside the grant period. And that actually pops up from 2 or 3 different people. Payroll after the 31st should be charged to another grant year, and that kind of stuff.
Exactly, right. So with the first part, for the payroll, the second week of payroll that was charged does not belong in the 2012-2013 grant period. It's for June 1st through June 6th of 2013, which relates to the following period. Therefore, in the 2012-2013 grant year, it should have been accrued but not charged to the 2012-2013 grant year. Then with the lease for the building, even though the CAA had to pay 2 weeks for the lease space for May 15th to May 31st, 2012, these 2 weeks occurred prior to the start of the 2012-2013 grant, and pre-award costs cannot be charged to the grant year unless they've been approved by the funding source. So let's just take a look at a polling question. Take a moment to answer that. It covers the hypothetical that we were just looking at.
All right, that poll is open. We only put a minute on this one as it is a shorter question than the others that you usually get about a minute and a half for. And thank you for the active participation on that last hypothetical. I actually did get a deluge of people that were saying much along the same thing. You need to start looking at prorating, or some of your costs would not be allowable from May. So thank you again for all of that participation, and hope to see you on the next one. And just a few more seconds on this poll question to get those answers in. The poll is officially closing, and we will be able to display for you in a few seconds.
Okay, so it looks like 4% said that yes, pre-award costs can be charged to a grant, 23% no, and 38% maybe. And yes, maybe is the correct answer. So generally, no, pre-award costs cannot be charged to a grant. However, if prior approval is obtained from the funding source, then they may be charged. So, as we've been discussing, you may only charge costs to the period in which the obligation was incurred. In other words, costs must be matched to the proper fiscal period. As a result, you must carefully track which funds are being expended and for what period. So remember, charging pre-award costs requires prior approval even where they benefit the program. Now let's take a look at another hypothetical. So please take a moment to look this over and try to identify any issues or problems that you see here.
All right, I have a couple of comments in, but please feel free to continue to put them into either the chat or the Q&A. To start us off, it says there is clearly a conflict of interest, but the Code of Conduct does not address it. And our other comment that is already in says, as I read the Code of Conduct, the brother could participate in decisions as he is not specifically excluded. However, the policy itself could be a problem.
Great, exactly. So the Code of Conduct that exists here is not much of a Code of Conduct. First of all, it does not define what a conflict of interest is. Nor does it include enough individuals. So exactly, it does not mention siblings of employees. However, it should. Immediate family of an employee, they can create conflicts of interest. Also, agents and officers and board of directors or other individuals that if they can create a conflict of interest. And then with part 2, I just want to see if we have any more comments.
We have had one more that came in that says the Board of Directors should have disapproved such a move because it was not in line with Code of Conduct.
Right, so actually here, as was noted, the existing Code of Conduct does not even cover siblings. However, it should have. And right, so even even where conflict of interest is brought to the attention of the board of directors, that will not necessarily cure the conflict of interest.
I also want to just mention something here, that the Code of Conduct really only talks about procurement. It doesn't talk about the situation here, which appears to be actually hiring the brother as an employee, although it's a little bit unclear. But so it doesn't even address the issue of whether you can hire relatives as employees. So that's kind of a somewhat separate thing. And so I think what it shows is that, you know, sometimes people look too much at like individual policies that are required by individual rules. And perhaps if you look at, for example, the A-110 procurement rules, it'll say you have to have a certain code of conduct. But if you look at it carefully, that really only relates to procurement contracts as opposed to other types of conflicts. So it's often very tricky to sort of figure out how all the different types of potential conflict of interest issues and provisions relate to each other and how to put it all into one policy. It's not that easy. CapLaw does have a few sample policies on its website on conflict of interest that you may want to take a look at. And the other thing about the second piece of it is that aside from the question of the code of conduct, which I think we all agree is not sufficient, how would you address this? Now, I suppose it's possible that it might be okay for the president to hire his brother as a bookkeeper, although I think that's a really bad practice. But let's just say maybe it's okay, but only after, I would think, that it goes through the regular advertised hiring process. In other words, if this is just a situation where the executive director just decides to hire the brother without advertising it, without going through a normal hiring process, it probably would not be okay, even if, in fact, the brother is qualified.
Right, and were to proceed and hire the brother in this situation, it should carefully document its reasoning, and it should carefully document that it did go through a selection process, that other people applied and were not qualified, and hopefully it can also show that the salary given to the brother bookkeeper is reasonable given the market conditions. So now let's take a look at polling question number 4.
Which is open, and the question does appear on the screen for you. All right, you have just under a minute to finish up this question and get your answers in. Well, just a few seconds remain on this poll, which is officially closing, and we will be able to display for you in a moment.
Okay, so a conflict of interest would arise if which of the following people were hired at a CAA. 23% A, an individual who co-owns a cleaning company that is often used by the CAA. is hired to run a grant program. Looks like 2% said B. 2% said B, a lawyer that works in a firm that provides legal services to the CAA offers to volunteer part-time to help evaluate and select procurement contracts. 0% said Z, the daughter of the executive director volunteers with registering clients for a job training program. And 36% said A and B, and 6% said all of the above. And the correct answer is A and B, or D. So with A, an individual who has a financial interest in a cleaning company or a vendor that is often used by CAA, if that individual is also hired to run a program, that individual that individual has a financial interest in their cleaning company or whoever the vendor might be, and might then have an incentive to use their own company to help run the program, and so that would create a conflict of interest. B also creates a conflict of interest because even though the lawyer is working in a volunteer capacity, that lawyer has control and influence over procurement decisions, and so also has an interest in maybe getting his own law firm or her own law firm with more work with the CAA. Okay. So just to summarize on some of the points we've made, you must have a code of conduct policy, and the policy must define what a conflict of interest is. So what is a conflict of interest? A conflict of interest arises when an employee or that employee's immediate family or an officer or agent or a partner has a financial or other interest in a procurement transaction. And as we saw in the last hypothetical, even where a conflict of interest is disclosed to the board of directors, the conflict is not cured. So remember, your code of conduct must be written. It's important to define what a conflict of interest is. Your policy must also include disciplinary actions for violations. The policy should also address the board of directors, and it is good practice to have regular trainings for the board of directors, supervisory staff, and all employees. It's also good practice to have everyone sign a statement of compliance annually. Also, your policy should prohibit employees, officers, agents from soliciting or accepting gifts or favors from vendors.
And sometimes there can be kind of a threshold on that. Often, you know, anything over $25, something like that, or maybe over $50 is pretty typical. So you can, you know, they can accept small things like mugs and that sort of thing, or you know, maybe lunch, but not some big thing. Okay, it's back to me here with hypothetical number 5. So again, if you could take a look and see what you think, give us some comments. CAP received a Head Start grant at the start of the program year, 204 children enrolled, and we'll assume that the start of the program year was, let's say, September 1st. Attendance was as follows: 58 were absent for an extensive length of time, 14 children named in the class list never attended even one day of activities, 23 listed children were absent since April and 10 since March. So what are your thoughts on that? What issues do you see there? Okay, any comments there?
We have one fairly general one. It doesn't appear that they manage the grant very closely.
Okay. All right, we'll give it another few seconds if you have any comments, or else, of course, if you want to call in, you can do that as well.
Sure, and we do have one more that's come in that said they did not deliver on contract obligations in terms of number of children served, so no amount of documentation would be able to explain that.
Okay, I think that's correct. And what this is really getting at here is a requirement on monitoring and reporting. And so I think the first comment certainly goes to that, which is that, you know, was there enough monitoring of this situation on a sort of daily basis? You know, did people know at the top that there were problems with the number of children that were participating in the activities, absences, and so forth? I know that when I did a session back a few months ago, I believe that there was the session was actually on sort of added value of board members and examples of case studies showing examples where the boards had really sort of changed the direction of the organization or made significant input into the organization. And one example that I remembered was that at one point someone, I guess there were reports given to the board about enrollment numbers and so forth in their Head Start program, and a board member asked for a little bit more detailed information, and in trying to get the answer to that, the executive director realized that in fact she didn't have that information. And they didn't really have any way of getting, with their current system, they didn't have any way of getting that type of daily detailed information that the board member was looking for. And as a result of that, they really ended up changing their whole system for tracking on a current real-time basis what the attendance was and so forth. So it really shows that it's important to be able to track the attendance, and that the numbers go far enough up the chain so that if there are problems and issues, that people can try to do something about it before it is too late. So I think it gets to the monitoring issue. Okay, let's go on to the polling question.
All right, that should be open now on everyone's screen. You do have a minute on this one because, again, this is one of the shorter ones. All right, you do have about 15 more seconds to go ahead and get those answers in. All right, the poll is closing. And we should be able to get those answers out to you momentarily.
Okay, so 22% yes, the CAP does have to provide access to the weatherization records. 39% no, and no answer was 39%. Well, I think this is, in a way, kind of a trick question again. I think the answer would be generally no. However, there are circumstances where I could imagine that they would have to provide access to those records. Let me give you an example. Let's say there's been some suggestion or some suspicion that the grantee was using Head Start advances to pay for weatherization expenditures, weatherization activities. In that case, I could imagine that the CAP would have to provide access to weatherization records. Also, let's say there was a question of allocation of shared costs. I could also imagine that there might be some requirement to have access to some weatherization records. Now, you know, it may depend on what those records are. Would they have access to the client records about individual clients? No, probably not. It's sort of on a need-to-know basis. Again, I think the answer would be generally not, but I could certainly imagine situations where it would be appropriate for the CAP to have to disclose certain records relating to the weatherization program, especially on the expenditure side, to a non-weatherization funding source such as Head Start. Okay, so let's look at then the last substantive slide here. That's 2 CFR 215.51 on monitoring and reporting. And what that says is that you have to manage and monitor each project, program, sum award, function, or activity supported by the award. That's, you know, it's kind of obvious, but I think, as with many things, it's obvious, but it's always good to ask yourself the question, especially on the monitoring part, how are you monitoring it? You know, I know for Head Start, there are certain very specific requirements that a self-assessment is done, and, you know, there's that regular 3-year cycle. Maybe for weatherization as well, but what I find sometimes is that there's no overall sort of general rule about monitoring programs at CAPS, that sometimes what happens is the monitoring is done as is required by the particular program, as opposed to just sort of a general principle of doing internal monitoring on a regular basis. So again, that may seem kind of basic, but if you sit down and think about it and ask yourself, how are you doing it, it may be helpful. Again, monitoring the subawards to ensure audit requirements are met. This is also something that can be very tricky, especially with Head Start. You know, you can't just give the subaward to another organization and just sort of hope they do it right. You need to go in and actually monitor, and that includes many times on-site visits. You know, they may say they're doing something, but boy, you're in for a rude surprise if Head Start goes out there and finds out that they're not really doing it. That may be, for example, criminal record checks of their employees, that sort of thing. Submit performance reports as required. We suggest you have kind of a tickler system. Maybe it's something on your computer, on your calendar, to make sure that reports are submitted. You don't want to find out after the fact that one of your employees didn't submit the report at the time that they were supposed to. And of course, the federal government may make site visits as needed. With that, we are finishing up this webinar. I do want to mention, of course, that part 2 of this webinar will be Thursday in 2 days at the same time, so 2 p.m. Eastern time, and we will cover the following areas that we've not covered today: competition procurement, prior approval, subawards, cost sharing, record retention, and equipment. So please do join us on Thursday. And I believe you could still register. Cashin, are there still spots available for Thursday's session?
That is true. If you go on to either the partnership or CapLaw website, you can still register for Thursday.
Great. Okay. And also, we just want to remind you, of course, look at these lovely photos of New Orleans. This looks great, especially those beignets there. So 2014 conference, June 18th through 20th in New Orleans. So hope to be talking with most of you on Thursday. See you then. If you have any, before I end, if you have any questions, I know we have one question here, and if you have any other last-minute questions, we do have a minute or two. We have one question that wasn't specifically discussed in this session, but we'll answer it since we have a minute. Is lobbying considered a, quote, legal service, unquote, if done by a law firm? Well, I would say it is a legal service, but that doesn't mean that it's allowable. It could still be a legal service, but the rules about spending funds on lobbying would still apply, so it could be both. And I guess what I mean by that is if it is lobbying, then generally speaking, you cannot use federal funds to do lobbying. So it doesn't really, you don't get out of it just by having a law firm do it rather than a lobbyist or doing internally. It might still be a legal service as well, but it's still lobbying. Any other questions?
That is all that I have seen that has come in, though if you do think of questions, do go ahead and send them to me, Cashin, at CYIU at communityactionpartnership.com, and I can get them over to CapLaw to make sure that we get them incorporated into Thursday's session. And with that, any closing words before we reconvene Thursday?
I don't think so. Thanks so much, Cashin, and thank you to all of you for listening.
Thank you, everyone. And there will be evaluations that pop up. We do appreciate you participating in that to let us know what you liked and did not like about this session, what we can do better with our trainings in the future. Thanks, and see you Thursday.